Dear viewers, welcome to yet another edition of Expert Speaks. We are into Q2 of financial year 23-24. We have just completed the quarter ending June 23. This is the time we look back and see how the quarter has gone by, what are the observations we have made in the market, how does the future outlook look like. To do this, I have requested our AS Fund Manager, Harini Dedhia, to be present on the show today. Stay till the end of this video. She has made lots of observations which are of very good significance for an investor like you. So this is NRI Money Clinic for you, and I am Dr. Chandrakant, but your financial guide for a happy living.
NRI Money Clinic. No hype, just the right advice.
Dear viewers, to take you through the quarter which has gone by, Harini Dedhia, our popular faculty member, will be presenting to you the India scorecard. For those of you who are my regular viewers, you know who is Harini Dedhia. If you are somebody who is watching Harini Dedhia for the first time, let me give a brief introduction to Fund Manager Harini Dedhia. Harini Dedhia started her career from New York a few years before. She started her career with a hedge fund. Subsequently, she came back to India, started her career with Galla Bansali Stockbrokers. She was managing the Truffle investment. Currently, she is the chief research analyst as well as a fund manager with Tamora Investment Managers, a boutique PMS firm located in Mumbai. The funds managed by her have got 4-star rating both by CRISIL as well as PMS Bazaar. She has been a very popular faculty member on my channel. The shows done by her have drawn very good attention by investors. It's time to hand over to Harini to take you through what happened in the last quarter and what people can look forward in the quarter that is unfolding right now. It's over to you, Harini, for your scorecard of what happened in India during the last quarter.
Thank you, Dr. Bhatt, for having me on your show, and especially for this quarterly feature, because it, I think, even helps us sort of sit down, take a step back, and really look at the bigger picture evolving over here, and do it in that same structured format every quarter. So thank you so much for the opportunity. With that, I think I would want to get started with the outlook for the Indian equity markets. Where are the threats? Where are the opportunities? And a review of the quarter that's gone by, right? So the last time we did this was in the month of April. And I would really request all our viewers that if this is the first video you're seeing, that please do go see the video that we recorded in April, because we covered a lot of the underlying economics in our thinking, in our perception, how it's playing out, which will form the context for the narrative that we're building on today. So that video would be very instructive for the same. With that, I would start on with the market outlook for the month of July and for the quarter and for the few quarters coming forward. Before I use the appendages of my slides, I really wanted to talk to you about what we had discussed last time, right? Last time around, we had made the case that, the time correction is in the market. We don't know how long it would last for, but we feel that this is the time to really start investing again. Little did we know that our thesis would play out so quickly, so abruptly, almost, right? So in the 3 months since we last conversed on the market outlook and threats and opportunities in equity investing in India, we've seen almost a 15% run up in the index itself. If you go a step lower and look at some of the mid caps and small caps in India, the returns are far better. So the 3 months have been somewhat of a dream run, and we'll get into the reasons why that has actually happened. So on the broader picture, we have not rallied independently, right? This rally has been more of a global rally, in that the largest market in the world, which is the US, has also given you a good 15-16% return. Dow Jones has given you a slightly lower return, but the S&P 500 has done that 15-16%. And this is at a time when we've seen the rate hikes over the last 1 year to be very, very steep. But what has changed? Why did the market at such high rates start, really being risk on right now? And I think the answer to that question lies in the stability that started emerging in a lot of factors, right? So your interest rates pretty much have started to top out, right? There might be a 25 basis points hike here and there, depending on which country and which central bank your jurisdiction falls under. But more or less, we're seeing that the interest rate hike cycle has started to cool off. And this is because the underlying inflation itself has started to cool off. So in the month of June, the consumer price inflation index in the US has dropped to almost 3% now, right? This is from the highs of 7.5% that we saw last year. So when this happens, in general, there is a lot more calmness, a lot more predictability and stability that enters the environment. For India, we are seeing it on two other counts as well. Our rupee has stabilized now. So in fact, last time we had discussed this, that we don't really see the rupee taking a further hit. And that has materialized where we see the rupee has held to this level of 82 rupees to the dollar. And inflation in India was never really going at very crazy levels, right? We were maintaining ourselves at 5.5%, 6%, but that was a tight bracket in which we were maintaining ourselves. Now that the US consumer price index inflation has come down, we're finally trending a little bit higher than the developed markets, but we're still holding constant to what has been our average inflationary rate in India. The biggest reason for this is crude oil prices have been constantly declining, which is great news for India, right? We've seen the $100 plus crude oil prices for the barrel come down to almost $70, $71 now. And the great thing is that this has also tremendously helped government finances. Not surprisingly, none of this fall in crude prices has actually been passed on to the customer yet, right? So all of this is currently windfall profit for oil marketing companies and the government agencies that own these companies. And when we do really expect to see it translating into economic benefits for consumers, really is probably 3 to 6 months leading up to the general elections in India, right? Because you need to have that tool in your arsenal at that point of time to really bring down prices and really bring down inflation. So at this point of time, I think that 5 to 6% inflation is also in a way artificially being propped up versus the rest of the world, not because that there is an unreliable print or anything like that, but it is simply because that crude oil prices correcting has not translated into petrol and diesel prices correcting for Indian consumers as yet. And we believe that will come about in another 3 to 6 months' time in preparation for the general elections. So with that context set, we've seen a tremendous rise in Nifty. The 15% move has been in the last quarter, which is far higher than what we've seen in the S&P 500 and Dow Jones, where the 15% move has been for the last year, not for the last quarter, right? If we really see from the base of June 2022, then the index is up almost 25, 30% odd. So we've seen a tremendous rise. And yet it is funny that this all-time high index has not really been one where a lot of wealth has been created in the last 2 years, right? The reason for that is the markets had already come up to 18,500 in the month of October 2021. And so from there, it's hardly a 4-5% move that the market has made. So while the recent rally, there is a sense of joy and glee that's around everywhere, which is great. But if you see from the perspective of, from October 21 to now, we've not really made tremendous money in Indian equity, right? And this really takes me to my next point, that in the financial year 2023, the markets were flat. We saw 1% rise on the index. But for the financial year 23, the sales growth that the top 500 companies of India reported was about 7.5%, with an operating profit or an EBITDA growth of 19.6% and a 10% PAT growth, right? So the operating profits of these companies have gone up 20%, yet the stock prices on a whole at the index level has not really gone anywhere, right? So below you see a chart from uh, for the last 2 years, and you will really see that since October, we've pretty much been flat, right? There's been a lot of excitement along the way, a lot of acidity causing moments along the way. We've had the, Ukraine Russia war being the big event. We've had the fears of US recession being a prolonged concern along the way. And yet, markets are pretty much where they were about 20 months ago. So what has happened is the expectations that the market had in 2021 of what earnings would be in 2023, in FY23, has been consistently declining, right? In October 21, the average consensus on the street was that Indian Nifty 50 companies, so the top 50 companies of India, would report an earnings of 874 rupees for the FY23 year. That in December 22, which is the second time the market attempted a new all-time high, the earnings projection had come down to 820. And the actual number that came out was 807, right? So the reason why market has stayed pretty much in this range has been because earnings expectations have constantly come off, right? And now if we just zoom in into the quarter, we'll see that the quarter was actually slightly better than expected, right? So if you even hear our previous conversation, we had left it off at saying that we probably don't expect a great quarter. We expect more margin pressure and more sales growth concerns to come up. And I must say that the Indian corporate world at large has surprised us. There are obviously pockets like, chemical companies or pharma companies that disappointed. But I think on a broader level, we've seen the Indian corporate earnings being far stronger than what was anticipated in the last quarter of FY23. So despite my earnings expectations for FY23 being not matched to what I had in October 21, despite my 10-year GSEC or my debt yields or my bond yields going up, we've seen this phenomenal new rise in the market, and that has predominantly been on the back of domestic and foreign flows both, right? So between December and June, December 22 and June 23, we've seen over $6 billion now in FII inflows into India, right? And this has been one of the most baffling stories of the last quarter, really. So the calendar year-to-date investment that has come into India is now sitting at over 1.1 lakh crores, which is astounding, but not too surprising, because after every year of outflow or negative inflow or outflow that we see from India, we see that FII investment does come back with a bang for at least some time, right? And practically speaking, we still believe that they have underallocated to India, right? I think right now everybody agrees that from all the major economies in the world out there, India is the one country where there is a regulatory framework that is adhered to, there is a democracy that is adhered to, there is an English-speaking population that can converse with the outside business world very, very easily. There is a cost advantage that is definitely there for our manufacturing sector. And with all of that, India is one of the bastions of growth from the major economies in the world today. It is the one place where IMF was certain that there would be no recession in 2023. So India was the only country that IMF assigned a 0% probability for a recession in 2023. And the story of the FII flows, why I think would remain strong over the course of next 2, 3, 4, 5 years as the story of India pans out, is today India is 3% of world's GDP, but it is only 1% of the global portfolio allocation, right? And this has to correct, right? At some point or the other, you cannot ignore the most flourishing in terms of growth major economy from your allocation. So we believe that that there are pockets of obnoxiousness. We're not saying that valuations are very sanguine today in India, but we believe that given that the visibility of growth has been far better now than it was in October 21, given that compared to October 21, we are getting things at a better valuation on the broader level. We think that we will see sustained flows. There will obviously be months and quarters where we'll see a downturn again in the flows, but over a 3 to 5 year period, we will see increased allocation because we cannot be 3% of world's GDP and 1% of world's allocation with the kind of growth we're reporting among major economies. So I've been referring to these pockets of obnoxiousness all throughout, and make no mistake that we believe that at this point of time, doing a lump sum very big investment in Indian equity may not be the most prudent way to go about it, right? This is the point of time where we would say that you should definitely be part of this growth story, but probably do a STP kind of mechanism where you would stagger your buying should the market remain like this. If the market does end up giving us an opportunity to deploy in one go, we will again, sort of give a call the way we did in the month of March and April, where we were very clear that this was the time to deploy. Right. So in the pockets of obnoxiousness, there are two particular areas that I wanted to highlight, and there might be many, many more, but there are two particular areas that we wanted to highlight, right? So the capital goods in sector, which is the industrial machinery sector, we believe that this rally in capital goods has come solely on the back of a significant expansion in order book that these companies have seen. It's not come on the back of earnings. What has happened as a result of that is a lot of the future growth for these companies is already priced in to these companies. For whatever reason, should that growth of 20% plus for the next 2-3 years that is being priced into these companies' stock prices does not come in, we are going to see a really painful period over here, right? It is very easy for these order books to not get executed on time, to get delayed because of funding requirements, or to get delayed simply because there is nothing available on the infrastructure side for you to deploy that you had thought would happen. So there could be a lot of scenarios that could play out in which a company that has chosen to give you an order would choose that, okay, looking at the macros today, we're not very comfortable doing this investments. So if you see the 32% performance for the financial year 23 in the stock prices of BSE capital goods has come on the back of 8% operating profit growth, 5% PAT growth. The one good thing that I would want to cite out is these companies have never been as delevered as they are today. So you see a debt to equity of 0.06, which is very, very low compared to their own history. At 19% return on equity, these companies are as capital efficient as they've ever been, but they are still priced to perfection. Should there be any delays, you will see a time, if not price correction in these companies. The other segment that has really baffled us has been the hotel segment. I mean, when you look at the occupancy numbers versus 2019, right, which was the last year, which is free of COVID, so pre-COVID to today, occupancy in hotels are up only 1%, right? We've taken all the big brands that are listed in India, right? Indian Hotels, IHCL is Taj, EIH is Oberoi, and Chalet operates a couple of hotels like Courtyard Marriott and Renaissance, and then Lemon Tree. And what we see is across the board, occupancies versus FY19 are up marginally, probably 1%. For the industry also, that number is just 1%, but rates versus 2019 are up 35%. And if you guys are anything like me who love to travel, this summer would have been extremely painful looking at some of these hotel rates and flight rates out there. I think they've reached sort of obnoxious level. And for 1% hike in occupancy, a 35% jump in rates, we don't think this is sustainable. But what has happened on the good side for hotels is because of COVID, they were given an opportunity to restructure their cost base altogether. Do we really need 1 employee per room, or can we do with 0.9 employees per room, right? Those kind of questions were being answered during COVID. Those kind of processes that are required to then implement the answers were also taken head on. So what we're seeing is the EBITDA margin jump versus 2019 is far significant than what we used to have traditionally in the hotel industry. So everybody sees an EBITDA margin today, which is on an average 10 to 12% higher, 10 to 12 percentage points higher than what it was pre-COVID. So the profitability of this sector has really shot up significantly. But we still think that this is something that has to normalize. You cannot have, prices of an item going up 30-40% when the demand has just gone up 1%. If I have to really summarize our view so far on the markets and Indian equity specifically, we think that 3 to 5 years, there is a lot more visibility that's there. The resilience that they've shown in the Q4 earnings is really significant. FIIs will have to correct their allocation. We cannot be 1% of allocation if we are 3% of world's GDP. Having said all of that, we still can't debate that the market is cheap or, very, very exciting and enticing at this point of time. We would, at this point of time, want to advise people to go step by step, to stagger out their buying, even if it means that in the short term, you end up looking foolish to your dinner party friends or hosts or whoever it is, because the market might rally far longer. But we just believe that there has to be a little more rationality in prices again in a lot of pockets in the market for us to do big lump sum deployments. We are bottom up research guys. We will always try and find opportunities that are mispriced and try to allocate money over there. But on the whole, we can safely say that the market is not as conducive to doing a lump sum investment as it was in March and April. So now getting down to the sectors. So last time we had called out auto and banking, and not surprisingly, they've been the leaders of this rally in the last 3-4 months in India. On auto, our view was that PV will grow faster than CV, and we are seeing that in that Mahindra and Maruti both have done really, really well in India. Two-wheeler was the only segment where volume surprises can come in, but we continue to prefer ancillaries. That has also played out well for us and for rest of the market as well. Going forward, we are not that sanguine on autos anymore. Again, it comes more from a point of view of things being priced in for good execution already, right? So a lot of the growth that we've seen in the Indian auto industry has come from us being able to export our auto components or our automobiles in the last 4 to 5 years. We think that those estimates that a lot of people have could come under some sort of, question marks going forward. And the way we've priced in, we've not left any room for those question marks to appear and, still enjoy the same prices and the similar returns that we've had so far. So while there should be margin recovery for a lot of OEMs, as we've seen a stable commodity cycle so far, we don't think that we can see too many surprises over here on the positive side. So this is something that we think has already started to be priced in very, very well by the market, especially in the last 3-4 months rally. In the banking space, one stat that we had sort of thrown out there was HDFC Bank was opening 6 branches a day, 6 branches a day, because of the impending merger and because of what that meant that they had to grow their deposit book by. That is the kind of competition that is there in the banking sector. We believe that as their own rate of borrowing has gone up, as competition has also stepped up, the margins, the financing margins that these banks earn will start coming under pressure. We've seen a lot of growth in banking come on the back of unsecured lending, and we believe that will also get some credit cost hikes for banks that they've not seen last year. We don't expect a big major NPA cycle as yet because we've not made those big loans as yet. And even if we have made some loans here and there, we've not really seen enough time go by where they would, become non-standard accounts or anything like that. So while we're not expecting a significant downturn or a significant bad NPA cycle, we do believe that incremental ROEs are going to be weaker, incremental margins are going to be weaker, and incremental costs are going to be higher. So banking, which has also been the second leg of this rally, we think it would not be prudent at this point of time to go ahead and increase weightage over here or buy more than the underlying index or anything of that sort for the time being. And in fact, if we may say so, we think it's time to go back to the great quality lenders, that those who have sustained their performance across cycles, who know when to withhold growth so that they don't have any bad loans and etc. appearing on their books. I think those are the guys that will start doing much, much better incrementally going forward. So these were the two sectors that we had spoken about last time. And I think increasingly we are even more convinced that one needs to trim weights or at least not allocate anything more in these two sectors than whatever they already have in their portfolios. So what does one really buy, right? I mean, that has always been the biggest question on everybody's mind. You know, you can give us or somebody can give me all the macro knowledge, but how do I really understand industries? What am I supposed to look at? What am I not supposed to look at? So I think one place that we really wanted to, focus on was on pharma and healthcare. And you might have heard me say this once before as well. I think on the whole, for the year FY23, we've seen pharma report a 24% growth in operating profits, which is met with a minus 7% stock price performance for the year, right? We think that this is something that is going to do well in the future. One, valuations are trending below 5-year average or just at 5-year average now for the sector. So this is one sector where we don't think things are priced for perfection or great execution as yet. I think people want to see more proof of the pudding, because this sector, honestly, for the last 7 years has not made any money for investors on the whole, right? So Nifty Pharma 7 years ago and today is at the same level. Within this, the biggest problem area that had cropped up for Indian pharmaceutical companies was the fact that we were a major player to export generic drugs to the US. And that had started, seeing a lot of trouble areas. We had seen a lot of US FDA action on the ground over here, where US FDA would come and, put import alerts on our plants or shut down our plants effectively. And there was a lot of pricing pressure post Obamacare that had happened on the generics market in general. We had seen double-digit disinflation, right? Which is unthinkable of when you think of what we are seeing in current scenario, where there's only been inflation all around. That this segment is actually seeing double-digit disinflation happen, and that we believe is something that has now started to moderate out, right? It is sort of trying to reach its eventual conclusion, and we're going to start seeing, minor single-digit price degrowth happening on the old generics portfolio. But there has also been a lot of work that's been done on compliance and regulatory side by the Indian companies. There have been a lot of approvals that have started to come through for Indian companies. And the effect of that, I think, will be seen incrementally even more so for our pharmaceutical majors. So this is something that we are most confident about because we believe that the good news has already started to shape up for this sector. The two other sectors, though, that we want to call out are IT and consumer. So for the financial year 23, IT stock prices were down 24%, despite a 12% growth in operating profits. Consumer stock prices were down 11%, despite a 16.5% growth in operating profits. So on the whole, both these sectors have seen about 25 to 30% correction in valuation, so to speak, correct? In IT, because our IT industry is predominantly linked to exporting services to the developed world, we will see some more pain come in. We've already seen the results of TCS, HCL Tech and Wipro already come out, and they've been on the softer side. And we think that this will continue for the next 2 to 3 quarters. But there will be a time in the next 2 to 3 quarters also where the risk reward would start becoming favorable if one was to own these companies. And while FY24 itself on the whole, because 2 quarters are still expected to be weak as per our understanding of the business, we think that there might be a case to start looking at this sector, which has otherwise been a bastion of secular growth for the Indian corporate world. And it's one of the cleaner corporate governances in terms of the whole sector that we've seen in India. On consumer, there are two very separate stories that we see emerging. One very, very tactical in nature, or very, like from a 2-3 year perspective in nature, that we see shaping up well, and one from a more long-term perspective. And you would be surprised to know that none of these are to do with the emerging middle class of India, right? We believe that that is actually the most competitive segment of consumer sector in the country. There are too many brands that come up. There are too many companies competing for shelf space. And as an investor, it becomes very, very difficult to take that call on which company is going to succeed versus another. You can always have, your staples that will do well or something like that. But, to take those really big, bold calls, it becomes very, very difficult if you're playing the middle of the pie. Why do we see an opportunity emerging on the rural side is because we believe that rural growth will finally make a comeback. There is one very, very big reason for that. We've had 2 great years in terms of grain production behind us. But during the pandemic, a lot of the population that had come into the cities, the migrant population or the migrant laborer population, went back to the villages. So the same farm that was supporting just a couple now had to support the 2 kids or the 3 kids that came back from the cities. And the same farmland therefore became a source of income for multiple more people than what it was originally planned for. Which is why, even though we saw grain production hold up, we saw MSP, which is the support prices for those grains, go up, we didn't really see a significant improvement in the rural demand in this country. And that is something that we think is now shifted decisively as more and more people have come back to the cities. They have started finding jobs in the city very easily. We have seen an uptick in a lot of construction activities, both on the government infra side and on the private side. This is probably much to the bane of all of us Mumbaikars here. The amount of construction, again, both on the government side and on the residential side, that we're seeing in Bombay has been unlike anything we've seen in the last decade. We paid the price for it with record high pollution in the month of Jan and Feb as well. But we think that because of that, rural wage growth in a very, very real way is going to make a comeback. And we're already seeing initial indications of the same. So that is something that we think is going to be the one interesting thing to look out for in the consumer space. And from a long-term perspective, we think that if India was to do very well over the next 3, 5, 10 years, because we are a relatively or majoritarily open economy and an open polity where we travel a lot, we see a lot of the other world, we have free access to a lot of information on the internet, a lot of understanding of what does luxury mean to people that do not stay in this country. What are the things that people are capable of doing? And therefore, what are the things that we can aspire to, right? And that is something that we think will be a cornerstone of anything we will do in the consumer space in India, where we will want to build an allocation to consumer brands that cater to this luxury demand and luxury appetite in this country. And that we think is going to be a more structural story. And if you're getting good prices on a structural story, then, well, nothing better than that, right? So this is incrementally where we will be looking for opportunities in our portfolio. I'm not saying that we're going to sell out everything else and buy only this, but incrementally, if we get money, that's where we're looking to deploy our money into. So I think with that, I'll wrap up today's discussion on the opportunities and the word of caution on Indian markets, and hand it over back to Dr. Bhatt. Thank you so much.
Thank you, Harini, for the detailed interpretation and the fund manager's view of the quarter gone by in India. Thank you very much on behalf of NRI Money Clinic for you. Dear viewers, hope the video that I have done today helped you to understand what exactly is unfolding in the Indian stock market. If it did help you, do give me a thumbs up. If you are a person who is watching this channel for the first time, or if you are yet to subscribe for the channel, please hit the subscribe button and press the bell icon. Don't forget to share these videos with your friends and relatives and the near and dear ones. Thank you very much for watching this episode on NRI Money Clinic. I shall be back with you with yet another expert on next Tuesday. Till then, stay safe.
Press the bell icon for more details and subscribe our channel.